You look at any bull market, and within that bull market, there are brutal corrections where it shakes out all the weak hands and everybody who's in it has a year in which they lost money and they feel stupid and everything. Just, don't play that game. Keep, for instance, long-term goals of, or long-term predictions of, say, $10,000 or $15,000 an ounce for gold, a couple of $100 an ounce for silver, and commensurately high prices for other commodities. Gold and silver, like you said, they had a nice correction now. So there's a decent chance that they resume their bull market sometime in the not too distant future, if not right now. They look great. Silver is cheaper than gold based on the gold silver ratio. So if you're just going to buy one physical, I would say overweight silver right now.
Gold and silver have already shown how violent a bull market can feel from the inside. Sharp drops can make patient investors doubt the trend, but the broader setup still points to a long cycle in real assets rather than a short-term trade. John Rubino, a longtime financial writer known for his work on debt cycles, currency risk, and precious metals, argues that the current weakness in commodities should be viewed in light of the possibility of a much bigger move ahead. His long-range targets remain bold: gold at $10,000 to $15,000 an ounce, silver in the hundreds, and similarly powerful gains across key commodities. The practical message is to avoid letting daily price action control the decision. A correction can be uncomfortable, especially after a strong run, yet it can also create better entry points for long-term buyers. Silver looks especially attractive relative to gold by the gold-silver ratio, while beaten-down miners may offer value after 30%, 40%, or even 50% declines. The better approach is steady accumulation, with patience carrying more weight than timing, because the real opportunity lies in owning scarce assets before the broader market accepts how much higher they may go over the next several turbulent years. Now, we present the clips from John Rubino's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
You look at any bull market, and within that bull market, there are brutal corrections where it shakes out all the weak hands and everybody who's in it has a year in which they lost money and they feel stupid and everything. Just, don't play that game. Keep, for instance, long-term goals of, or long-term predictions of, say, $10,000 or $15,000 an ounce for gold, a couple of $100 an ounce for silver, and commensurately high prices for other commodities. And just let that guide you. As long as we're not there yet, then you want to continuously add to your positions. And that makes it a lot easier to sleep, because otherwise it'll drive you crazy. Any market is very volatile, especially when it's doing well, and commodities are no exception. So if your self-image is tied to whatever the copper price is, or uranium or gold, it'll just drive you crazy. So try your best not to pay attention to what the price is and what the action is on any given day in any given part of the commodities complex. Just gradually keep adding, and eventually you'll have a nice portfolio of this stuff at favorable prices, and you'll end up being a really successful investor. Riding long-term bull markets without being shaken out is basically how you do it. And this is our chance in the commodity space to have one of those decades that every investor dreams about. Gold and silver, like you said, they had a nice correction now. So there's a decent chance that they resume their bull market sometime in the not too distant future, if not right now. And so they look great. Silver is cheaper than gold based on the gold-silver ratio. So if you're just going to buy one physical, I would say overweight silver right now. And then a lot of the miners had very serious corrections, 30 or 40 or 50% in some cases. So there's some very high quality, cheap names out there now. And so this would be a good time to start a dollar cost averaging program in the gold and silver miners. And then copper's story is just great. I mean, if AI is going to become what it's going to become, or what people think it's going to become, and electric cars turn out to be most of the cars that are on the road, then we're going to need way more copper than we have, which makes copper miners with working mines right now very valuable, and their stocks are great. And same thing with uranium. A lot of the things that we're planning to do as a civilization are going to require a lot more uranium for nuclear power plants than is now being produced by the world's mines. So those mines are valuable. So that's a list of commodities that are probably going to do really well in the future. And then there's a lot more that I really don't know that much about, rare earths and a lot of things that fall in the strategic metals category that are also going to do great. The U.S. government looks like they're getting ready to put price floors under a lot of these things, which would really change the dynamics of that kind of a market, because usually the big risk is that the price falls out of bed one day and then all of a sudden your mine's not valuable anymore. It's not profitable. But if the government is going to name the price at which they're willing to buy unlimited amounts, and you've got a mine that's producing at a lower price, then you're kind of a risk-free asset at that point. So that I think there are careers that are going to be made in the commodities space, figuring out how that dynamic plays out and how it applies to the various miners out there. But I think just in general, the whole complex is going to do really well. One of the things you don't want to own in a currency crisis is the kind of financial asset that depends for its value on the value of the dollar, right? So if you own bonds and they're paying you X number of dollars per year, and the dollar gets less valuable, then the income stream from those bonds becomes less valuable, and the bonds themselves go down in price. That's the kind of thing that we're looking at now. And so short-term government paper is actually a good thing to own, because government will definitely pay you on a treasury bill. But when interest rates go up, the yield on the treasury bills that you're rolled into when the government pays you back on your old short-term paper, they go up too. So you're protected from inflation by the fact that short-term interest rates will rise during an inflationary period. And you are threatened in that same period by owning long-term bonds, because they don't roll over. You just are stuck with them if you buy a 10-year or a 20-year or a 30-year bond. And that makes them really volatile in relation to interest rates. So if interest rates go up because inflation's going up, then the value of your bond portfolio goes down. So yeah, you don't want to own bonds. What you want to do is swap financial assets like that into real assets, like commodities, like gold and silver and oil and uranium and copper, because they will tend to do well in a currency crisis, because governments can't just make more gold or silver out of thin air. They can't. They can't print gold, they can't print silver as they can with their currencies. So in currency terms, precious metals and the other commodities are going to do really well. And we're just at the early stage of that bull market. I think we've got another 5 to 10 years for that to run. I think if you're just now getting into this space, you want to start with the least risky assets and then work your way up to the riskier things over time. So start with gold and silver physical, buy some coins, buy some small bars, store them in a very safe place. And then when you feel like you have enough real money as the bedrock of your financial life, then move on to the equities that deal in these things, and start with high quality there too. Pick the really good names in the different parts of the commodities complex. The high quality gold miners and royalty companies, and the high quality copper miners and uranium miners, and add a little bit of them too. And once you feel like you've got enough of them, work your way down, get some mid-tier equities, and then eventually, if the market gives you enough time, you'll be buying the junior miners and the explorers, because they're the ones that are most risky but have the most upside. At a certain point, once you educate yourself by buying the high quality names and watching them for a while, then you're ready to look for 10 baggers. And there are quite a few of those potentially in the commodity space right now. So make sure you don't mess with those things, the lottery ticket stocks, until you're very well versed in what separates a good one from a bad one in that part of the space. So start with quality, work your way down.
Beyond precious metals, the commodity case rests on demand that is hard to fake. Artificial intelligence, electrification, and electric vehicles all require more copper, while nuclear power plants point toward rising uranium needs. Rare earths and strategic metals add another layer, especially if government support creates price floors that reduce downside for producers able to mine below those levels. That makes the sector more than a simple inflation hedge. It becomes a supply and demand story tied to the next phase of industrial policy. Still, the risk is real. Physical gold and silver sit at the safer end, followed by major miners, royalty companies, and high-quality copper or uranium names. Mid-tier companies and junior explorers may offer the biggest upside, including potential 10-bagger returns. But they belong later, after enough knowledge has been built to clearly separate serious projects from lottery ticket names. Now, let's get back to the interview.
The Fed has facilitated this massive increase in debt starting in the 1980s and then accelerating in the 90s and the 2000s and until now. And at some point, there's going to be a crisis that the Fed tries to address, as it always does, with much easier money. And it's going to turn out that that doesn't work anymore because there's so much debt out there that the bond markets just refuse to accept the idea that the Fed is going to dump another $5 trillion or whatever to bail out whoever. And it's not going to work. And then the financial markets are going to realize there is no more adult supervision in this market and that we're basically on our own. And so we'll get something like the crack-up boom that the Austrian School of Economics talks about, where everybody just gives up on a currency and they just, whenever they get any of that currency, they convert it into real stuff. The price of real stuff goes through the roof, which is basically raging inflation, and the currency basically just craters. So that's coming. And, I've been saying it was coming pretty soon for a long time now, and it hasn't hit yet. But we're heading that way fast based on the way all the numbers are built up. So I think something like that is coming. And at that point, the Fed won't be able to manage it. So, the guys who are in charge of the Fed right now, their days of the masters of the financial universe are probably coming to an end. We just don't know when exactly. We bailed out the global economy during the pandemic with massively lower interest rates. Something like 1/3 of the bonds that were trading in the world had negative interest rates for a stretch there. And that gave us 2022 when we had double-digit in official inflation in the U.S. We had a massive increase in the cost of living, which terrified everybody. And then we had to raise interest rates back to more or less normal levels, which is where we are now. But look what's happening to the interest costs on the government's debt. The government had taken on all of this debt over the past 30 or so years with gradually lower interest rates, which made the debt easy to manage because the interest rates they had to pay on that debt were reasonably low. But now, rates are back to kind of normal levels, 4.5% on the 10-year Treasury. And the interest cost on U.S. government debt has rocketed up to about $1.6 trillion a year right now. So that's on top of the structural deficit that the government has to run to pay off Social Security and Medicare for the baby boomers that are retiring now. And that interest cost has to be borrowed, so that turbocharges future deficits. It makes them much bigger than they would have been otherwise. And so we're in kind of a death spiral now where we can't cut interest rates because that'll reignite inflation. But we can't let interest rates stay at the current level because that's causing our interest costs to go parabolic, which is turbocharging deficits and making things much, much worse going forward. So we're in this place where there is no solution. And we just haven't figured it out yet. There will be a crisis. Something will have to be bailed out. And then the government will have to finance that bailout. And that's probably where we find out that we can't do that stuff anymore. And, there are a lot of potential catalysts for that kind of thing. In other words, sectors that could have some kind of a crisis that forces the government to bail them out. So it's just a question of what's going to be that catalyst. And we don't know that yet, but there's a lot of likely suspects. Some tech stocks peak and then tank, as tech stocks tend to do. And that pulls the overall stock market down. And that gets everybody panicked about maybe a falling stock market leads to a recession. And then what's going to happen? In other words, a garden variety equities bear market and a garden varieties recession. Those things happen all the time, and it's, I'd say we're grossly overdue for that kind of thing going forward. So if that happens, historically, it tends to pull down gold and silver and the other commodities. So that happened in 2008. It happened in 2020. And it was brutal for a short time for gold and silver and the other commodities. And that's a very possible thing. That could totally happen, and that could cost you 50% or 60% of a commodities portfolio in the short run. But what happened in both of the times that happened recently, previously, and the times that happened before, is that the Fed steps in aggressively to stop the recession from turning into a depression. So we get massively easy money. That would be the excuse for the Fed to cut interest rates back to zero again, and then ramp up QE, and then maybe even start buying equities this time around. So that would be really good for gold and silver and the other commodities. And it's highly likely that that's the way the Fed will respond to any kind of real turmoil in the stock market and any kind of negative stretch in the economy. So the question is, do you get out of commodities in anticipation of something like that? Or do you, like we talked about, just don't sweat the squiggles and just ride it out? Because if you're doing dollar cost averaging, for instance, that means you're putting the same amount of money each month in a list of commodity stocks, let's say. And the price of those stocks go down. Well, that's bad for what you own, but it's good for what you intend to buy in coming months, right? Because you get a better deal on those stocks. The same amount of dollars buys you more shares. So if you look at it from that point of view, then, okay, there's a correction in the stock market, and that leads to a correction in commodities. So be it. You keep on buying because you know that the long-term prize in terms of higher commodity prices is still out there, and it's going to happen. And now you've got the Fed on your side engineering a new bull market in commodities. So yeah, we could definitely have a disruption in the financial system that leads to commodities dropping. But it would probably be a V bottom where they tank and then they spike. And trading in and out of that would be really hard. So I would say don't try. Do not try to trade this market, despite the fact that there are some big risks out there in the short and intermediate terms. Just steadily acquire, and then otherwise don't pay a lot of attention to this stuff. So and that's psychologically a lot healthier, and really financially too, because you are not going to be able to successfully catch the top and the bottom of this kind of a market.
The risk behind the commodity view is a debt system with fewer exits than it had in the 1970s. Back then, policymakers could crush inflation with double-digit interest rates because household, corporate, and government balance sheets were stronger. Today, higher rates raise government interest costs, deepen deficits, and threaten over-leveraged markets. Cutting rates could restart inflation, while keeping them high makes the debt burden worse. That tension points toward a future bailout cycle in which the central bank may return to zero rates, renewed quantitative easing, or asset purchases when stocks, banks, or another sector breaks. That does not mean the path will be smooth. A recession or equity bear market could drag gold, silver, miners, and other commodities sharply lower for a while, just as happened in 2008 and 2020. A 50% or 60% hit to some commodity positions is possible in a panic. But the deeper lesson is that trying to trade every top and bottom may be more dangerous than enduring volatility. A steady dollar-cost averaging strategy turns pullbacks into lower entry prices, while the long-term thesis remains anchored in currency weakness, scarce resources, and the likelihood that real assets gain purchasing power as paper claims lose trust. Share your thoughts about this interview in the comments section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.